Good morning, Credit Goddess. How are you doing this morning? I see you. I see you. I see you. Let's bring her on up. There she is. Good morning, Credit Goddess. How are you?
I'm good in this windy Florida.
Oh my goodness. What are you doing? You out and about walking, Rose?
I'm actually driving.
Okay, all right. Well, listen. Whenever you want, why don't you go ahead and introduce yourself to the folks? Whenever you can.
Yes, okay. I was putting on my seatbelt. Hey, everybody. This is Rosalora Lewis, also known as Credit Goddess. I am all things credit score improvement strategist, business credit coach, NAV business loan broker, and an educator in the credit space. So I'm here to support Don. I know I haven't been here in a while, but I'm coming consistently. So bear with me. And if you have any questions, you guys, in relations to credit, and I'm really interested in this topic that you have here. 40-year mortgages are the best thing ever.
Yes.
I want to talk. Let's talk about it.
Let's talk about it. Okay. Hey, Credit Goddess, I have something for you though. Somebody asked me something the other day. All right. Guy gave me a call. Gave me a call about student loans. Okay. And I didn't know this could happen, but his student loans got charged off and somebody else bought them. So he's trying to figure out how to pay his student loans after somebody bought the debt. And I'm telling him, you signed a contract with whoever you signed the contract with to pay those student loans. Once they have been paid, somebody paid for that debt, and now somebody else owns that paper, but you didn't make a contract with them.
No, not at all.
So I told him, you need a credit expert. You don't need me to pay off the loan. You need a credit expert to navigate you through that. And you may not have to pay them at all now.
Right.
Oh boy.
Yep.
So I think I need to hook you two up together. What do you think?
Yes, please do. So I can explain it. Yes.
All right. So folks, if you heard that, listen, these student loan things, you got to know what's going on. When whatever loan that you have, if somebody, if that loan defaults or gets charged off, somebody else buys the paper, that means that the original person who had the loan got paid. And now you made a contract with them. You don't have a contract with whoever bought the loan. If they call you and try to bully you and say, you now owe us, and you believe them, that's a problem, right? Don't believe them, okay? Number one, don't give them any information when they call. Number two, tell them to stop calling you or you're going to issue a cease and desist letter, okay? And number three, I don't owe you anything because I don't have a signed contract with you, and you can't prove that I do. So listen, you need to have some help on this to get out from under how all of this works. You need to know the laws involved. You need to get with a credit expert like Credit Goddess. If you're in a situation like that where somebody else has bought your debt, you need to know you no longer owe the debt. All right? You need to know that and need to know what to do about it. Thank you for being here, Credit Goddess. We appreciate you. All right, I see Dahlia in here. It's good. Listen, folks, if you've been in here before, you know the drill. We're going to be going over some valuable information this morning. I want to say good morning to brother AJ. I'm looking for my home now, and your info is so valuable. What should I know at the closing? Oh my gosh, brother. All right, brother AJ. He's tuning in from YouTube this morning on this. Listen, there's a lot you need to know. You need to contact my office at area code 256-886-1867. That's 256-886-1867. Contact my office. Let's get a consultation going for you. What should you know at closing? A lot. All right. Actually, you should have called us before closing, but that's okay. Let's take it from here. Or you can go to ice10k.com, ice10k.com, and get our contact information from our digital business card. So let's get together, brother AJ. Let's see what we need to talk about, because there are so many variables. What we talk about here on this stage, in this program, I can give you some basics, but believe me when I tell you, everything that you hear on this program is not all there is to know by any stretch of the imagination. It's not all you need to know, because some things never come up unless there's a particular situation involved. And then we can't cover every single contingency. So when you have a particular deal going on, like you, brother AJ, I don't know the particulars of your loan. I don't know what they've told you. I don't know what you bought. I don't know what your down payment was. I don't know what your interest rate is. I don't know any of that. I don't know if it's an ARM. I don't know if it's a fix. I don't know any of those things. So when we get all that information together, brother AJ, and then we talk about what should our next moves be, what should we look out for, but know this, the bottom line is this: what is the least amount you're going to pay for that house? Your negotiation, when you negotiated the price of the house, that's not where the pricing stops. Right now, you have a mortgage on this house. The bank has bought your equity, and now you're purchasing it back. What you want to be able to do is purchase all of your equity at the absolute lowest interest cost, not interest rate, but the absolute lowest interest cost available to you, which is going to be different from your neighbor. All right. So folks, it's all about not paying all of that interest, keeping your costs low, and it's going to be different for everybody. The examples that we give here in this show don't apply at all times, everywhere, to everybody. We'll give you some things to think about. And when we give you those things to think about, that should trigger something that says, you know what? We need to call the P.I.L.L method to see how all of this applies to us. What type of financial education do I need in my situations to overcome? All right, folks, we shall overcome. All right, so listen, continue to invite some people in. I know that this topic is going to be very, very important. I got a bunch of people in here right now. Keep sharing the room. And if you're in here and you want to ask a question, raise your hand, come to the stage. If you have a comment on 40-year mortgages, raise your hand, come to the stage. But even if you don't, even if you just want to listen from the stage. You're actually helping the room out by listening from the stage if you're here on Clubhouse. So raise your hand, come to the stage, and listen from the stage. So I'm going to invite Miss Dahlia up, invite her to come up to the stage. And she may not say anything at all. I'm going to invite Jonathan up, okay? He may not say anything at all, but he doesn't have to. The fact that Jonathan has 367 followers, as soon as he hits the stage, his 367 followers will get notified he's on the P.I.L.L method stage. All right. Good morning, Miss Dahlia. How are you doing? Can you speak to us this morning? Maybe not.
Good morning. Good morning. Yes, I'm a little bit in a hurry here, but yes, I just wanted to say good morning, everyone, and all the listeners. And I'm so happy to listen to your show, and I'll be there. I'll be here. I'll be hanging out and listening to you. Thank you so much.
Thank you so much. Mr. Jonathan, how are you this morning, sir? You see, he doesn't have to say anything. He can, but he doesn't have to. That's great. So, folks, Jonathan.
Good morning, John. How you doing?
Good morning, sir. How are you?
I'm doing well. And yourself?
Man, I'm telling you, I can't be any better. I am so glad to be on the other side of this thing. You know, we had to shut the show down early the other day because I started coughing and could not stop. Kurt Nugent our producer, had to finish the show for me because I had a coughing fit. And listen, it just overtook me. But anyway, it's good that this is a team effort and we got the show finished. So, Jonathan, thank you for being here this morning. So do you have a comment on these 40-year mortgages, man?
No, I don't have a comment just yet, but I will in the future.
All right. Sonia, I haven't seen you in like forever. All right. It was like this time last year I met you. So why don't you go ahead and listen? She wants to come to the stage, invite her up. Miss Sonia, how are you this morning?
I am fabulous. How about yourself?
Excellent. What are you doing these days?
So I spent the last year of my life working with a friend of mine, and we have officially invented and got to market the first breathalyzer that detects marijuana, alcohol, and illicit drugs.
Oh my goodness. That is going to be a game changer. How about that, folks? You heard it here first.
We're hoping. Fingers crossed.
All right. Okay, Sonia, thank you for being here.
How you been?
Listen, I've been doing okay, except for the last 2 weeks. We were dealing with the flu, getting over that, but we're back in the saddle, and with over 200 shows now. And today we're going to be talking about 40-year mortgages. All right. So listen.
Those are going to be great for us, right?
I think. Listen.
If we do the pill method.
If you do the pill method, if you listen, it's not just doing the pill method, it's understanding these loans from the pill method perspective. Because right now, our financial education that we have right now, if you follow everything that you already know, it is designed to keep you in debt longer and cost you more money using the current mode of thinking. If you take what bankers and the financial gurus are telling you that are best practices, these best practices, I'm telling you, they're not giving you the numbers to back up what they're saying. Here at the Pill Method, we give you the numbers to back up what we're saying. So anybody else wants to come to the stage and listen, I would appreciate just raise your hand, come to the stage, and then we're going to jump into this thing right away. All right. But before we get started, we need you to focus on one thing. I've got my 10K card up at the top. Anytime you want to refer to what it is that we're doing, when you can get out of debt, click on the 10K card. If you want to get the only book that talks about this subject on Amazon, click on the 10K card up above, ice10k.com. If you want to know the month, day, and year, you want to be debt free, get a savings and earnings report. Click on the 10K card and get that. ice10k.com will get you to all of this information. And so, Brother AJ, thank you for being here. So you want to do the exact same thing. Does there anybody else that wants to come and listen from the stage this morning? Raise your hand. You don't have to say anything if you don't want to, but when you hit the stage, you are going to say, Terry, you're in here all the time. You're in here all the time. I'm going to invite you up to the street. Husan, you're in here a lot too. We're inviting you up. All right. So people aren't raising their hands. I'm just going to invite them. All right. Invite you up. Thank you, Husan. Thank you for being here this morning. Can you speak to us this morning?
Sure. Greetings, salutations. Good morning, good evening, good afternoon, everyone. I'm a big fan of Ice 10K. I won't be able to speak much, but I'm happy to share the stage. Well,
that's a good thing you're not going to be able to speak, because with that radio voice, you're going to take over my show. So you have to just stay quiet, man. Listen, I didn't know. I did not know. Okay. All right. So don't come in here with that voice trying to take over. People, listen, Don, shut up. We want to listen to Husan. All right. Well, thank you very much for being here. All right, folks, let's jump into it. Oh, somebody else wants to come up. All right. Come and listen from the stage. Get on the stage. All right. Plus, people will read your bio. All right, you'll read their bio, and if you have a product or a service, maybe somebody will get interested in what you're doing. So, is it Cordera? Is that how you pronounce it? Cordera? I don't know if you can talk to us this morning. Maybe you can't. All right, but that's okay. Just hang out on the stage.
Yes, it's Cordera.
Hey, Cordera, how are you doing?
I'm doing all right today. How about yourself?
Excellent, man. What brings you to the room?
I just want to come in and learn some new valuable information. It's my first time in, so I'm more here to listen and not to talk.
All right, you just go ahead and listen, man. But listen from the stage, because right now you've been on Clubhouse a little while. You got 5 followers. All right. And your 5 followers just got notified that you're in here on this stage. And then maybe they'll come in too to learn a little bit. But thank you so much for being here.
He asked in the back chat.
Yeah.
What is the P.I.L.L method?
All right. P.I.L.L method stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. So the P.I.L.L method is the most powerful program on the planet. All right. To save interest on your loans. Our average client pays off all of their debt in an average of 7 years. That's their mortgage, student loans, credit cards, car loans, everything in about 7 years instead of 30 years to never. That's how powerful the P.I.L.L method is. And we have our educational system is second to none. The P.I.L.L method is a education company that actually uses AI technology to do the math. All right. So when you have a loan, the bank does their math and charges you a ton of interest. You need to know how they do what they do so that you don't have to keep paying that interest to stay in debt forever. So if you can cut your interest costs by 75 to 80% using your current budget. I found this on the web. Oh, be quiet, Siri. We didn't ask you. All right. If you want to understand how all of this works, how the bank makes their money, then you will then understand better how not to pay it. And then when we engage our process to save you even more money, it is phenomenal. So Cordera, thank you so much for being here. All right. So Justice came in. Justice Beat, good morning. Would you mind recapping the conversation in which a debt has been bought and if you still owe it? Not a problem, Justice. So here's what we're talking about. If let's say you have a credit card that was charged off or a loan that was charged off, and a debt collector bought that debt from Visa or from you bought something and the loan got charged off and somebody else bought the paper, okay, like a debt collector. You're going to start getting calls from that debt collector. Number one, you made the deal with whoever you made the deal with, whether it was Visa, whether it was with a department store, whether it was the hardware store in your area. You made a deal with them. You signed a loan with them. Okay. So for whatever reason, the loan didn't get paid and it was charged off, meaning they said, okay, I can't get everything, but I want to get something for this debt. So they sell it to someone else. So they get pennies on the dollar for that debt. Now, as far as the original owner of the debt, they have been paid. You no longer owe them. All right. They've been paid. You no longer owe them. And now somebody else bought the debt. They're going to try to call you. All right. They're going to try to call you and make you believe you now owe them the money, which is completely untrue. You don't owe them any money because you didn't contract with them. You contracted with the original owner of the debt. So, Justice, does that make sense? So get somebody that knows something about this, like Credit Goddess. Contact her. And if you know anybody who has a situation like this, they can walk you through the steps and save you time and save you money. They can even show you how to stop the harassing phone calls and mailings. It can all stop. It can all stop once you know what your rights are. So get with somebody who knows the game, all right, like Credit Goddess, and they'll be able to help you. I hope that helps. I hope that helps. You're welcome. You're welcome. So what else we got? Let's see. Miss Legacy. Dow's voice is an amazing. Thank you. All right. And let's see here. All right. Good morning, beautiful people. All right. So, folks, let's jump in. Let's jump in right now. If you want to see what we're talking about, go to YouTube right now. Go to YouTube right now and jump in. Jump in on YouTube. Go to YouTube and search P.I.L.L method on YouTube, and you'll be able to see our examples. I'm putting on the screen right now. We're going to put on the screen. We're talking about 40-year mortgages. And folks, this is the first time for all of you that are in here right now. This is the first time anyone anywhere has seen what I'm getting ready to show you. This is the first time I've done this in public. I've done it in private, but this is the first time I've shown this in public, and you will not believe your eyes. So if you know someone, okay, if you love someone, even if you like someone, even if you don't like someone, you need to invite them in here right now to watch us on YouTube. All right. So they can see what's going on with how mortgages done. Now you've seen me do examples on how a higher interest rate can actually end up saving you money on a mortgage and getting you out of debt cheaper and faster. You thought that was powerful. I'm going to show you the power of extending the term on a loan, going from a 20 or a 30 or even a 40-year loan. The more years on the loan, the more powerful it is for you once you understand it. Now, you thought the higher interest rates examples were something. When you see what I'm getting ready to show you about these 40-year loans, it's even more powerful than the higher interest rates examples I've shown you in the past. So if you want to see what I'm getting ready to do, all right, I need you to do one thing for me. Just go ahead and tell us where you're from, either on Clubhouse, tell us where you're from, if you're watching us online, whether you're on Facebook or YouTube or Twitter or LinkedIn. All right, so wherever you're from, go ahead and tell us what's going on. Start inviting some people in. Let me put my stuff on the screen so that you will be able to see this. Hussein from Los Angeles, man, you're up early. So thank you for being here. So we're going to share this screen. All right. So now I've got, so we've got a $300,000. We're going to put on a $300,000 mortgage at 6% for 240 months. All right. And then we're going to calculate that. That is a 20-year loan. All right. And then we're going to add another one here. Okay. Another $300,000 loan at 6% for 30 years. Are we going to calculate that? And then we're going to duplicate the tab again, And now we have a $300,000 loan for 40 years. That's 480 months. 480 months. All right. Now, if they start having 50-year loans, oh my goodness. Let's just do another one. Just for fun. Okay. Let's do 50 years. That's 600 months. 600 months. Okay. 600 months. Listen, if anybody offered me a 50-year loan, I would jump on it with both feet. With both feet. I need you to share the room, start telling other people about, Troy, what are you doing sitting down there in the audience? That's what I want to know without your hand being raised. Okay. I don't even know what you're doing down there. All right.
He's looking extra cute today.
You look extra cute today. Troy, you better get yourself up here. All right.
Don, sometimes you just want to learn and listen. Sometimes you just want to stay in the audience. But thank you.
Well, listen, man, I appreciate you for being here today. Okay. Being an insurance expert as you are. All right. We appreciate you being here and listening in. So listen, anytime you all want to tap in and say something about these 40-year mortgages, this is going to be fantastic. All right. All right. Invite as a speaker. Oh my goodness. What? Listen, my day has been made. My day has been made. Miss Patrice Bobo Miles is here today. Miss Patrice, how are you doing?
I have laryngitis, so I can whisper.
Okay.
I hope you can hear me.
We do.
But I've got a question, because the 40-year mortgage is not necessarily something that's available in the retail market.
Okay.
It's really for those modified loans and modifications. So I'm curious to hear what you're talking about.
All right, great. Because there was an announcement. There was an announcement over the weekend that the FHA is now going to start offering 40-year loans. So number one, I want to ask, because you're in the business, have you heard anything about that? Yes or no? I know you can't talk very much, but there was an announcement over the weekend.
I've heard rumblings of a 40-year, but there's not really been a move to implement and roll it out in the retail area.
Okay, thank you for that. All right. That's why I love this room. That's why I love being here. Because if this becomes a reality, you want to know what I'm getting ready to show you so that you can take advantage of this. So if you want to see what we're talking about, everyone, if you want to see what we're talking about, go to YouTube. Let's look at the numbers. Let's look at the numbers. Okay, so right now, if you're thinking about a 40-year mortgage, all right, and they say the first time you hear it, what are some of the thoughts that cross your mind when you hear, oh my God, they're going to be offering 40-year mortgages? What are some of the thoughts that cross your mind? If you can't say anything, put it in the chat. All right. Good thing, bad thing. What are some of the thoughts that cross your mind when you hear 40-year mortgages?
Who wants to pay a mortgage for 40 years?
Exactly. Who wants to pay a mortgage for 40 years? All right. And listen, nobody does. Okay. So what else? What else are you thinking? What else comes to mind when you hear 40-year mortgages, everybody? All right. Lisa Pringle says, my mortgage payment would be lower. All right. So listen, the mortgage payment actually would be lower if it was a 40-year. That is true. All right. That is true. All right. Anybody else? Anybody else have a comment?
How much more are you going to pay in interest charges for a 40-year mortgage? You're going to pay a lot more total dollars for a 40-year than you will for a 30, a 20, or a 15.
Exactly. Those are the thoughts that come to mind when you start talking about a 40-year mortgage. Now, I want to show you some things right now, all right, that most people do not realize, and I'm going to put them on the screen. So if you want to see what I'm talking about, please go to YouTube right now on a secondary device. I put it in an amortization schedule so that you can see a 20, a 30, a 40, or a 50-year loan. And we're going to see the truth of the matter right now. Okay, so let me show you some. Let's start with the 20-year loan, 240 months. Okay, 240 months. Here's my payment at a 6% interest rate on a $300,000 loan. My payment is $2,149.29. Okay, first of all, when you get a 20-year amortization, okay, first of all, when you get a 20-year amortization, this is going to be your payment. And you sign that, you're locked in for the duration of this loan unless you refinance it, okay? To pay it off or refinance it, you're locked into that payment. Here's the first thing you need to realize. You don't need permission to have a 20-year mortgage. You don't need it. You can have a 30-year mortgage, and this is the 20-year payment, and you can make the 20-year payment on your 30-year mortgage. You don't need permission to do that. Let me show you the difference between the 20-year and the 30-year. Okay, here is the 30-year mortgage payment, $1,798.65. You can have this mortgage and make this mortgage payment, $2,149.29, if you want to. You don't need permission to get a 20-year loan or even a 15-year loan. So here's my advice to you. If you're in a loan and you want to refinance to a 15-year loan, just find out what the 15-year loan payment would be and start making it. Does this make sense to everybody? Okay. All right. So let's start with this. So now here is the amount of the payment on this. Let's scroll down to the summary. Okay. So we're going to make some notes. Make some notes on this. I need you to pull out your pencil and paper and make some notes on what we're talking about. I'm going to try to keep an eye on the stage. And if you're a moderator on the stage, help me out here and look for people who are raising their hand so that we can bring them up and they can ask their questions. Okay. So the total interest cost, if you keep the loan for the entire 20 years, is $215,000. So let's start there. We're going to take a look at what Ms. Patrice said is if you keep the loan for the entire term, you're going to pay more interest. So $215,000 on the 20-year loan. Let's take a look at the payment on the 30-year loan. Now your payment is smaller, it's $1,798.65, and they want $347,000 for the entire term. Now, remember this, you don't have to keep the loan for the entire term. You can pay it off early, and we're going to be talking about that. So now we got $215,000 versus $347,000. Let's take a look at the 40-year loan. All right. 40-year loan. All right. So 480. All right. Let me make sure I got this right. 480. All right. Your payment now is $1,650.64. All right. For a $300,000 mortgage at 6%, here is your total interest paid for 40 years. $492,000. $492,000 versus 30, which is $347,000 versus 20, which is $215,000. Now, I want to show you one more just for fun. 50-year loan. Okay? 50-year loan just for fun. Okay? There's no rumblings about this one, but I just thought I'd put it up here just for fun. $647,000 if you keep the entire loan, if you keep this loan for 50 years and pay it off this way. All right. Now, here's what I want to show you.
Basically, wait. By looking at all these years, I'm seeing that the longer the loan is, the more money the bank's going to take out of my pocket over time. Correct.
Over time.
So it benefits them for a longer time for us to have it, right?
What benefits them more is the lack of education on how these loans work. That's what benefits them. That's where they make their money. When you don't understand how the loan works and you keep it for this long period of time, they're going to make more money. All right. But let me show you something that most people have never seen before or never noticed. Let's take a look at the 20-year loan. Let's get down into the weeds here. The very first mortgage payment. All right. Let's take a look at the first two mortgage payments. $649.29 goes to principal. $1,500 goes to interest in the first month. In the second month, $652.54 goes to principal, and $1,496.75 goes to interest. I need you to focus in on the interest payments because this is what's key. This is the 20-year loan. I want you to now contrast that with the 30-year loan. Here's the 30-year. What? Here's the 30-year loan. The very first interest payment is what? Exactly the same number, $1,500. And the second payment is $1,498.51. $1,498.51. Let's go back to the 20-year loan. Let's take a look at the second payment, $1,498.51. $1,496.75. Not very much difference here. Okay. Now, let's take a look back at the 30-year loan. I want to show you the 40-year loan now. Look at this. $1,500 and $1,499.25. Very little difference between the 20, the 30, and the 40. Now let's look at the 50. Look at that. $1,500 and $1,499.60. The first two are virtually the same. Let me show you something. Now we're going to take a look at the first year on all of these mortgages. Let's take a look at the first 12 months on all of these mortgages and how much interest and principal is paid. If you make every single payment for 12 months on this loan, look what happens. You pay the 20-year loan down by $8,000 and it costs you $17,782.12 in interest cumulative over the first year. Let's look at the 30-year loan. What? Only you pay this down by $36.84, but look at the interest cost. Virtually the same, $17,899. On the 40-year loan, you only pay $1,858.23, but look at the interest cost, $17,949.45, virtually the same. Let's take a look at the interest costs on the first three. I want to make sure everybody sees this. Interest costs on the first three. 20-year loan, $17,782. 30-year loan, $17,899. 40-year loan, $17,949. And the 50-year loan, just for fun, in the first 12 months, $17,973.42. Wow. Now remember, with the P.I.L.L method, a lot of my clients are paying off these loans in 7 to 9 years. I want to show you something, what happens in the first 7 years on these loans. Let's go down to line 84. Any questions so far on what we're seeing here? Any questions so far what we're seeing here? All right. All right, watch this. We're going to go down to line 84, which is 7 years in. 7 years in. Whenever you do anything, folks, it is the cost of the loan that makes the difference to you. The cost of the loan. Can you manage the cost? All right. So now let's take a look. This is 5 years, 6 years, 7 years, 84 months in on the 20-year loan. You pay it down if you're making every single payment on time, right? We're not talking about the P.I.L.L method yet. We're talking about making every single payment on time. 84 months, you're going to pay this down by $67,000 but look at the interest cost, $112,966.20 in the first 7 years. Look at the interest cost in the first 7 years on the 30-year loan. There it is, $120,004. Let's look at the difference between the two. All right, $112,966, $120,004 on the 30-year loan. Now let's look at the 40-year loan, how much interest you pay between the 30 and the 40 right now. Let's take a look at that. 120,000. All right, we go down to 84. Look at this. Look at this. Look at this. Look at this. $122,000. So let's take a look between the 30, 120,000, and the 40, 122,976. Look at that. And just for fun, the 50, we want to take a look at that. All right. 84 months, $124,000. Would you think that the numbers would be so close in interest cost in the first 7 years on these loans? Would you think that? Just by thinking about the fact that this is a 40-year loan and how much extra money that's going to cost? But let me show you right now.
Don, I see why you got excited about the 40-year.
Come on, listen, why I get excited about the 40-year, Troy? Come on, tell me.
Because the cost is not that much different.
It's not. It's not. But let's look at what is different between the 20, the 30, and the 40 that's going to make a difference for us, okay? I'm going to start with the 20-year loan, and we're going to show you what prepayment of principal does to a loan. All right. Now, these are numbers I'm just picking out. These are examples, and I will repeat, these are examples. I am not saying this is how my program actually works. I'm just showing you what happens when you prepay. And most people do not know what happens when you prepay. And I'm just picking out some numbers here. So if we make our first payment here in January on the 20-year loan, $649.29 goes to principal, $1,500 goes to interest in January. Our February principal payment is now $652.54. So here's my question to you. Do I have to wait till February to give the bank an extra $652.54? If I have the money, can I pay the $652.54 early? Do I have to wait? All right. Or can I pay it early?
I don't have to wait.
I don't. What'd you say, Sonia? You don't have to wait. So
I don't have to wait.
All right. So if I don't have to wait, I can pay this early. All right. And all of this money goes to principal, doesn't it? If we direct the bank, I want to apply the $652.54 to principal. Look what happens. You're paid down to line 2 on your amortization schedule. All right. Already. You do not have to pay this $1,496.75 in interest. Okay. So you just lowered your overall interest bill by $1,496. And my next mortgage payment is on line 3 of the schedule. This becomes my new February payment. Does this make sense to everybody? All right. For paying the $652 early, I don't have to pay the interest on line 2. This is the 20-year loan. I'm now going to show you the big difference between the 20-year and the 30-year loan. Watch the principal payment. The interest payment is about the same, but take a look at the principal payment now. What? The principal payment on line 2 is only $300.14 as opposed to $652.54. If I want to get rid of line 2 on the 30-year loan, I just have to come up with how much money, folks? $300.14. That's it. I can prepay $300.14 and get rid of virtually the same amount of interest and still be on line 3 of my amortization schedule. Troy, Credit Goddess, Patrice.
Yes, sir.
Are y'all seeing this?
I'm seeing it.
Do you believe it? I mean, it's mind-boggling. Watch this. Now we're going to look at
all numbers and money.
It's all numbers and money, folks. If you know the rules to the game, you can win this game. The fact that we don't know the rules, all right, and we're just looking at getting a lower payment, man, we can get a lower payment and make some headway on this loan. So I'm going to stop here for just a second and focus here on if we know right now that I can pay an extra $300.14 on month 1 and get rid of virtually the same amount of interest. I need you to take a look at cumulative principal and cumulative interest for the first year on this loan. Okay? If we take a look at on the 20-year loan, I would pay $8,009.36 in 1 year and pay the bank $17,782.12. Okay? Here's my question. I know that if I keep the loan long enough, I'm going to give this bank this much money towards my principal eventually. $8,009. Here's my question. Do I have to give it to them in 12 monthly installments? This $8,000, do I have to give it to the bank in 12 monthly installments? That's all the principal payments added up. Okay? Comes to $8,009.36. Do I have to give that to them in 12 monthly installments, people? Let me see my answers. No, I don't. No, I do not. So if I have it, all right, can I make my mortgage payment here on line 1? I've already got $1,500. Okay, I already got $649.29 into this principal payment. Can I give them the rest of the $809.36 and be paid down to line 12 in 1 month? Look at that. I could be paid down to here in 1 month. And if I do, what happens to all the interest payments between line 2 and line 12? I just saved $16,318.74 by giving the bank this principal amount early. Now let's look at the 30-year loan. This is the 20. It costs $8,000 to prepay to knock out 1 year. Look at what we have to prepay on the 30-year loan. What? $36.84. If I prepay that, I get rid of virtually the same amount of interest I don't need to pay. But it only cost me $36.84 to get to that point on the 30-year mortgage. Oh my goodness. Listen, I need to know if this is good news or not. I need to know if this is good news to you or not, everybody. All right, let's start inviting some more people in here. Listen, Miss Brenda, I see you in here. All right, Miss Brenda, you need to come to the stage and listen from the stage. I'm inviting you up. Okay, and inviting. All right, thank you very much for being on the stage. All right, thank you so much. All right, so now look at this. $3,684 to accomplish the same purpose and the same amount borrowed at the same interest rate, but look at the amount of money going to principal. Now I'm going to show you the 40-year loan for the first time when we look at it this way. Watch this. Here's 40-year. I'm going to show you why I'm excited about the 40-year. Look at the principal payments on the 30-year. Now look at the principal payments on the 40-year. Oh my goodness. Interest payments are about the same, but the principal payments only $150. To get rid of line 2 on this mortgage, I only have to come up with an extra $151.39. That's it. $151 gets rid of line 2 and saves me $1,499.25 on the 40-year mortgage. In the first year, look at this. $1,858.23. You prepay that. You knock off the first year and save virtually the same amount of interest. Let's talk about it, everybody. Let's talk about this right now. Has anybody ever pointed this out to you when we're talking about a 20, a 30, or a 40-year loan? And listen, I hope these rumblings become true, that these 40-year loans will become common because the affordability of these houses, getting a payment you can afford. But man, you can take advantage of these principal payments. Now, listen, they better not start offering me 50-year loans. I'm just telling you, don't offer Don Daniel and the P.I.L.L method 50-year loans, because if you like the 40, watch the 50.
So I have a question.
Go right ahead. Who's asking the question?
Me, Shauna.
Okay, go ahead,
This
Shauna.
is my question.
Yeah.
So let's just say that we do this and we start paying the principal off,
Mhm.
and then we have a job loss or whatever, and you know, money's tight.
Yeah.
And we can't pay that extra principal. Are we okay with just like skipping 2 or 3 of those until money gets back in sync with the household and, you know, people are back employed? How does that work? Does that go negatively against our credit, or does it keep it going in a positive
Oh
way?
my goodness, that is a good question. If you have, let's talk about the 40-year. All right. If you have the 40-year, all right. Let's say you prepay that. All right. You've already knocked off a year. You saved $16,000. All right. So let's say you've done that. And let's say because of a reduction in income, all you can do is make your regular mortgage payments for the next few months. This amount of interest savings doesn't go away. That's permanent. You've already knocked off 12 months. Okay. You've gotten $1,800 worth of equity here. All right. If you paid the mortgage the way that the bank wanted you to, Miss Sonia, it would cost you $17,000, almost $18,000 to get this much equity into your home. But because if you prepaid it, it only cost you $1,500 in equity, and you're still on line 13 of your mortgage. Because you have a reduction in income does not do anything to affect your new amortization schedule that you just created by prepaying. You just keep making your minimum payments until you can start prepaying again. Does that make sense?
Yes. Okay, another question. So let's
Yes.
just say we buy the house.
Yep.
And you know how a lot of people, if it's their first home, money, usually that first home, we try to buy the biggest, best because we haven't got financially smart yet.
Mhm.
And so let's say that we can't do the full amount to the principal. Let's say if we could only do like 200 extra a month, you know, give up the Starbucks and throw it towards the principal in the house, would that still benefit us?
That is a very good question. Now remember, I'm just giving you some examples, excuse me, of what happens when you prepay. With the P.I.L.L method, our program tells you exactly how much to pay based on your income, Sonia. So we're taking a look at all of your bills, number one, and how much income you have and how much money is left over. So when it comes to putting extra money on your principal, the program is looking at this and say, well, this month you have about $150 left over after all the bills are paid. Our program then prompts you, excuse me, to put that $150 into your savings account. How about that? Put that in your savings account.
So I don't have to do all the math. Your program does it all for me. Even better.
Yeah, the program does all the math. Put that $150 in savings, and then for your family, when your savings account gets to a certain amount, that's when the program kicks in and says, let's take the money from the savings account and apply it to principal. That's how that works.
So you make it so easy. Thank you. I love it.
All right, so folks, you don't have to worry about it. But let's just say, for instance, I'm going to put a calculator on the screen. If I can pay $151 and save $14.99, okay, half of $150 is $75. So Miss Anya, let's say there is a reduction in income, and I can't put a whole $150 on when the program says put some money on. It's going to tell you need to put 75 on instead of 150. Okay, so that's half of this. So I would save half the interest. So we just round that off to $1,500. Okay, so half of $1,500 divided by 2 is $750. So $75 applied right here, Miss Sonia, would still save $750 in interest. Is that worth it?
That's worth it.
Well, listen, what if I don't have $75? I only have $35. I have half the 75. I can apply $35 and save half this $750. $750 divided by 2. $375. So $35 saves me $375 in interest at this point. You don't need a lot of money to save interest. You just need to know how the game is played, everybody. This is why I love the 40-year mortgages. Keep inviting people in. Raise your hands if you have some questions or even some comments. I need you to take a closer look at what we're getting ready to show you on the 40-year loan, how powerful it is. On the 30-year loan, the 20-year loan, if you have the money available, you can literally prepay $8,000. I'm so excited about this. On this $300,000 loan at 6%, 240 months, that's 20 years. Prepaying $8,000 takes out a whole year, saves $16,300 in interest, and your next mortgage payment is on line 13 of this schedule. Okay? Let me show you what $8,000 applied to the 40-year loan would do. 40-year loan, same, $300,000 at 6%. The payment is much less, but $8,000 applied to this 40-year loan. Look what it does. It knocks off 4 years. Saves $69,000 in interest. And your next mortgage payment is on line 49 of your schedule, prepaying the same amount of money. Same $8,000 it takes to knock off 1 year in the 20-year loan. Knocks off 4 years on the 40-year loan. R.L. Chance just chimed in and says, wow, who would have thought a 30-year mortgage was one thing, but a 40-year mortgage can work even more in our favor. You better believe it, Mr. R.L. Chance, and he's got a mind-blown emoji to boot on this. Folks, can you believe it? This is the first time we've shown this in public, where a 40-year loan you can do more damage to this thing and save yourself a ton of money. Listen, I've got to show this one more time. $8,000 prepaid to this loan saves you $6,000 on a $300,000 loan at 6%, and your next mortgage payment is on line 13. $8,000 prepaid to the 40-year loan knocks off 4 years and saves you $69,000 in interest you never have to pay, and your next mortgage payment is on line 49 of your schedule. Oh my goodness. Hey, listen, do you guys think that is that awesome information or what? You tell me.
That made the morning coffee 100% better.
100. Listen, I want to show you. Come on, sister. You listen. What do you have to say?
No, I was clapping.
Oh my gosh. Can you imagine this? Everybody thinking 40-year mortgage. Now listen, just for fun, do you all want to see what $8,000 prepaid to a 50-year mortgage would do? I need you to put some number 9s in the chat. All right, I need you to put some number 9s in the chat if you want to see what $8,000 prepaid would do to a 50-year loan. Listen, I wish they would offer me a 50-year loan. I would jump on it with both feet. Okay, so again, let's go back. $8,000 applied to the 20-year loan knocks off 1 year. $8,000 applied to a 50-year loan. Listen, 50-year loan, your mortgage payment is even smaller. Your mortgage payment is down to $1,579. Okay. If you have an extra $8,000 applied to the 50-year loan, let's scroll down. $8,000, 82 payments. 82 payments. Almost 7 years eliminated. And saving $120,000 in interest on this 50-year loan. Folks, extending the term is more powerful than anything I've ever seen when it comes to amortized loans. Listen, folks, if you think, is the P.I.L.L method bringing you information that you've never seen anywhere else at any time in your lifetime? Has anybody ever showed you this? If no one has ever showed you this, put a no in the chat right now. No one has ever showed us. Put a no in the chat. Put a no in your on the comments. No, it says Mr. Odawa says nope. Okay. No, nobody. Taye says, how do you account for the extra 10 years on the 40-year compared to the 30-year? Which 10 years are you talking about, ma'am? Taye, how do you account for the extra 10 years? I don't quite understand the question. And maybe you could clear it up for me. You mean how do we knock off more time? I don't know. So Tony Key says no.
I think I can see the question. Ice, what he's asking is the difference between the 30 and 40. How, if you're making the same amount of payment, how is it knocking off more on the 40-year versus the 30-year? That's what he's asking.
All right, let's take a look at this. Let's take a look at the 30-year because somebody may have come in late. I'm showing you on the screen now. I'm showing you the 30-year loan. I'm showing you the 30-year loan. I'm showing you the 40-year loan and the 30-year loan. Here's the difference. All right. Your payment number one on the 30-year loan is $1,798.65. Your principal payment is $300. It's starting out here, $300. Okay, $300. Yeah. Now, here is the 40-year loan. Here's the 40-year loan. Here's how it's constructed. 40-year, look at your principal payments here. 150, 151, 152. Your principal payment is cut in half on the 30-year loan versus the 40-year loan. The 40-year loan, your principal payment is cut in half. So when you have an extra $150, you can get rid of one line on your amortization schedule, Taye, okay? $151 gets rid of one payment here on the 40-year loan, but on the 30-year loan, it takes $300 to get rid of one line on your amortization schedule. That's what makes the difference. When you're attacking a loan, you attack the loan with the principal payment. And if I have a smaller principal payment, I can get rid of more of my loan with the money I have to work with. So if I only have an extra $1,000 to put on this loan, I can divide about 3 payments, that's $900, into my $1,000, and I can get rid of part of this one, okay? All right, that's what my $1,000 can do here. Because my principal payments are higher, I have to divide a higher number into my $1,000. But on the 40-year loan, I have a much smaller number to divide into my $1,000, so I can knock off more payments. So when you're attacking the loan, the principal payment matters, not the interest payments. So the smaller the principal payment, the more damage I can do to this loan. And interest payments I skip don't matter. Ms. Taye says, I see lower principal payments, just like what happens with the higher interest rate mortgages. Exactly. She says, amazing. The higher interest rate mortgages, but by changing the term, not only decreases the principal payment, it decreases the overall payment altogether. When I increase the interest rate, it increases my payment. But by increasing the term, I get a smaller payment and I get a smaller principal payment. The 20-year loan, my payment is $2,149.29. On the 40-year loan, my payment is $1,650.64. $1,650.64. Wow, I get a smaller payment and a smaller principal payment. That is exciting to me. I want to show you what happens with this 50-year loan. Watch the 50-year loan now. I'm putting on the 50-year loan. Here's the 50-year loan. Here it is. 50-year loan. Look at the principal payment now. Listen, if you didn't know any better, if you were not in this room, if you were not part of Clubhouse, if you were not in here on YouTube, Twitter, Facebook, LinkedIn, looking at these numbers, you would say at a 50-year loan, look at my tiny principal payment and look at all the interest I have to pay. But your interest payment on the 20, 30, 40, and 50-year loan are virtually the same. The only difference is the principal payment. And now that you know on a 50-year loan, all I have to look at this, Troy. Look at this, Troy. This is all. Listen, Miss Brenda. All I have to do is come up with $79.61 to eliminate 1 month on my mortgage and kill about $1,500 in interest. Look at line 12. Look at line 12. If I come up with, it doesn't even take $1,000 prepaid on 50 years, on a 50-year mortgage, it does. I don't even have to come up with an extra $1,000. $977.10 eliminates 1 year on this loan and still eliminates $16,000 in interest. So, ladies and gentlemen, I just got one question to ask you. If they were offering 50-year mortgages, would it be better for me to take the 20-year mortgage or the 50-year mortgage? And look at what would happen if I prepaid that money. Which is better, 50 years or 20 years? Which is better? I need you to put it in the chat. Is a 50? Come on, Troy. What do you have to say?
Don, a question. So we've been taught to focus on the payments and not the terms. Is that correct?
That is correct.
So now we need to focus on the terms because we can use it to our advantage because we understand what the terms are and take a longer payment because we can use it to our advantage.
We can use it to our advantage. And this loan still pays off in fact, our average is 7 years. A 50-year loan actually changes the game. Can be paid off in about 5 now. Okay. I wish they would start offering that, but let's get back to the 40 because I really do believe that consumers will be offered 40-year loans. And I would ask if you're getting ready to get a mortgage, ask if they offer 40 and 50-year mortgages. Just ask them. And ask around which companies are already instituting this. Who has a question?
Somebody in the backdrop said, it was Nita Martin. She said, regarding down payment, do you make a larger down payment in order to get a lower monthly payment?
Okay,
then apply the P.I.L.L method, or do you use less of the down payment and use those funds to prepay on the principal?
I would listen. If I had, give me an amount to put as a down payment. Give me an amount. Just type it in. On your question, type in an amount you would like to see as a Miss Nita as a down payment. All right, $25,000. Okay, here's what happens on a $300,000 mortgage. All right, so we're going to open this tab up. I'm going to show you what happens. Okay, so I can have a $300,000 mortgage or $275,000 mortgage, $275,000. Okay, at 6%. We're going to change that to the 40-year mortgage. All right, that's 480 payments. There you go, 480. There it is, 275,000. If I put it as a down payment, Miss Nita, I start out at 275,000 on payment number one. All right, that's the 40-year mortgage. Or I could do this. Take my 40-year mortgage, all right, at 300,000. Take my 40-year mortgage at 300,000, not put it as a down payment, all right? Now I have my $25,000. I've got my full 300,000. What if I put my $25,000 down as a prepayment instead of a down payment on this mortgage? Where would I start this loan? Let's go down to 2. Oh my goodness, I'm still scrolling. My finger.
Don, I was going to suggest, keeping the down payment, and then the other part that I know about. You could put that in there and then keep your money and maximize it in 2 different areas.
There you go. So now we're looking at over 120,000. That's 120 payments. That's 10 years. You can take your $25,000 on this loan and knock off the first 10 years right here. 10 years knocked off this loan. So you can actually start this loan on line 122 instead of on line 1. Now, I need you to take a look over here. It's still $275,000, isn't it? Put your money down as a prepayment, never as a down payment. And so you said something here, Troy. You said in 2 different ways. I think I know where you're going, but tell me what you mean. How can I use that money to benefit me in 2 different ways, Troy?
Well, one of the strategies is a person could put that into a such as a cash value life insurance, and then that is generating compounding interest at $25,000, and you can take that, and not only you're killing 2 or 3 birds with one stone, is growing tax free. It's also cover you in the event of your death, but you could take that cash and then start paying that extra principal off, and still have that other money to compound.
Ooh wee! So there's a couple of things here. We could take that. $25,000. Okay. Can we jumpstart our whole life policy, our permanent life insurance policy, with what do you guys call that when you overfund? Can we overfund it by the $25,000, Troy?
Yes.
Okay.
You can. There are some requirements, but yes, you can max. What the better term is max fund, but yes. Max
fund. Okay. That way we don't create a taxable event and cause the policy to MEC. What does MEC stand for?
MEC stands for Modified Endowment Contract, and basically what it says, based on the parameters of the policy, the death benefit, and other factors. If you go over that MEC limit, then the IRS are making a taxable event. So you want to stay under the MEC limit.
Exactly. So now, Troy, here's my next question. Could I get to the point where in a very short time, I could have enough cash value to pull out my $25,000, borrow it from my policy, and apply it as a prepayment to this loan? My $25,000, can I build that cash value up in a very short time so that I could pull that $25,000 out as a loan and then apply it to my mortgage? Could I do that?
You sure can. And since you are borrowing your own money, the IRS deem IRS code 770T is that money is non-taxable.
Dang it. Wait a second now. I got one more question for you, Troy. Because I'm pulling that money out, does that mean I'm pulling that money out of my policy? Because once I have it in my policy, the insurance company is paying me interest and dividends on that money. So when I pull it out, does that mean I lose the ability to make interest and dividends on that $25,000 if I pull it out as a loan?
No, if you keep the policy and keep it intact and continue to pay the premiums, you're still, and if you didn't take if it's more than 25,000, you still have cash in there, and it'll still be compounding and growing.
So are you telling me I could take 25 grand out and still make money as if my 25 grand is still in?
Yes.
Because I'm not taking out my money. I'm taking out the insurance company's money. My money is still in there working.
Correct.
Lord have mercy. Did you hear that, folks? Now we're talking strategies. Well, listen, we're talking next level strategies now. You're talking infinite banking type strategies along with P.I.L.L method strategies working together to not only save money, but now we're making money. We're making money and saving money with the same money. Listen, this is just making me tired. Oh man. Troy, where have you been, man?
I've been here.
Folks, are you hearing
and
this?
I want to add, Don.
Go ahead, boy. Go ahead. You keep talking. You keep talking.
With the infinite banking it's a strategy, and it's using life insurance. So basically what happens is your cash is the collateral. So you're actually borrowing the money from the insurance company. So your cash is the collateral. So while your cash is still in there, it's still growing and compounding, even though you have taken a loan out.
Wow. Miss Brenda, did you have something that you wanted to say? Because I see you muted your mic there.
Yes. Good morning, everyone. Excuse me for my voice, but Don, that's why I hadn't spoken. But I want him to reiterate that again.
All right, let's go. Oh, let's listen.
What Troy said, what y'all, explain that again. And also, Don, I just want everybody to know I'm a member of Don's the P.I.L.L method. I've been in the program for over a year, and it is awesome. Everything he preached, everything he teaches is absolutely correct. And I love the program. But still, I want you to go over that again. And Don, also, I want you to tell about the power of the penny.
Yes, yes, ma'am. We could do that. We could do that. So, Troy, give us that play one more time. Let's break it down so people get that, because we kind of went over that quite quickly. Let's talk about how we can use the both concepts together and what it means. All right, break it down for us.
Yeah, so using a cash value life insurance and typically a whole life policy, you put money into the policy and you what they call max funded. So you go over and beyond. You basically have three areas. You have the minimum, you have the target, and then you have max fund. Personally, I do not write policies if a person only can do the minimum. We either got to hit the target or max funded. And so, and the reason why is I don't encourage an agent to do a minimum because that policy doesn't have enough cash in it continue to build up to make this thing work. And so you may get a call from the insurance company 5 years later saying, "Hey, we need $10,000 to make this policy whole, or it's going to lapse." So you got to be able to have some cash to put in that policy. But anyway, so what happens is the IRS basically says that if you take a withdrawal, then you may pay taxes on it. Depends on what they call first in, last out. But if you borrow the money, so you're going to borrow the money, the cash that you got built up in there. Let's say hypothetically you got $50,000 in there. It's your money. You can borrow from it. So once you borrow that money, the IRS says you don't have to pay taxes on the loan. Just like if you have a 401k and you ever borrow from a 401k, you don't pay taxes on that money. So you borrow that money is yours. And what you're doing is with the whole life policy, you borrow the money from the actual insurance company itself. Your cash is the collateral. So the old saying OPM, use other people's money. So you actually are using the insurance company's money. Your money is collateral, but so your money, while it's still in there, is still growing and still compounding. And then you're just using the insurance money, and then you'll pay that loan back, or sometimes you may be able to not pay it back, but you need to have the insurance company run the numbers to say, hey, if I don't pay this loan back, will I still have a policy? Will it still be enforced? So, but it's just a strategy, and you have to sit down, with a trusted financial professional to be able to really go through this. But I appreciate Don offering this. But it's what he's showing you is his strategy, and then taking that money that you have, and you can put it in a life insurance policy and let it grow and compound, and then use that same money to turn around to pay that mortgage off in 7 years. I hope that answers.
Dang. I love it. 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 So folks, you could take that same money that we're talking about, a down payment, and max fund your whole life policy. All right. Now, last year, your clients averaged about what kind of returns on their policies last year, Troy? Can you give us some idea on the rate of return for last year?
Yeah, conservative number is about 7%. That's very conservative, but on average about 10 to 12. And then some can get a cap up to 15, but a conservative number, I stay conservative, about 6 to 7%.
6 to 7% earnings on your money. Okay. You now can take out, if you overfund it, you can now borrow $25,000 from yourself. Okay. All right. And then apply it to this mortgage. If you apply $25,000 that you got from your life insurance policy to this mortgage, you could knock off over 10 years off of this, 10 years. Save yourself what? 100. We're saving $174,000. We don't have to pay an interest. We get the equity practically for free. $25,000 in equity. We didn't have to pay $174,000 to get. All right. Now, we're still not done with this. We're still not done with this scenario, are we, Troy? We're still not done with it. Even though we could borrow the money from ourselves, we can. Our money is still in the policy, making 6 to 7%, right? But what if we gave ourselves our own amortization schedule to pay the money back to the insurance policy at an interest rate we deem necessary? What if I want to pay this money back to myself, Troy, at 6% interest?
Hey, and that's another option to, when you pay that money back. It's your money and it's still growing and compounding, and you can, a person can use it to start a business or, whatever they want to use that money, or buy some investment property. But I will say also with that policy, they'll have what they call living benefits. So in the event if they have some type of disability type of issue, like a heart attack or stroke, they can take a portion of the death benefit. If they pass during this time of the loan, they got the death benefit to pay off the mortgage. So there's some other benefits of having that life insurance policy also that people are not aware of. And also remember the growth. All the growth is taxed, is growing tax deferred. When you take the loan out, it's tax free. And so you could use that money for whatever issue that you want. And also a couple other things. It is in most states, it is exempt from creditors and lawsuits. And then also when if your child is going to go to college and you have to fill out a FAFSA and you have to address your assets, that cash in that policy is not considered an asset. Just want to add that.
Wow. Folks, listen, when I started this today, I knew we were going to have to do 2 sections on this. Troy, what are you doing Sunday morning?
Don, Sunday morning is church for me.
Okay. How early?
Yeah.
How early do you go?
I'm there about 9:30 Central Time, but I'm probably up most of the night because I'm preparing my Sunday school lesson. I think I got to preach also Sunday morning. So Sundays is
yeah. So if you're preaching and doing Sunday school, all right.
Yeah.
All right. Well, tell you what, folks, I'm going to, because we have insurance agents that are on board with the P.I.L.L method. Okay. I was going to have Troy come in, but he's going to be busy Sunday. We're going to do part 2 on Sunday. We're going to talk about how we can use insurance policies, and 40-year mortgages working together, because there are some things that he mentioned that we just don't have time to get into today. Like the riders, all right? Like the insurability rider for if you decide you want to get a whole life policy for your minor children, and ensure their ability to get insurance for the rest of their life, no matter what type of medical problems they could have in the future. So you can ensure their right to have their insurability can never be taken away from them because you got a rider on them as a minor. We're going to talk about that. We're going to talk about how you can take this money and kill 40-year mortgages. We're going to talk about that. We're going to talk about how you can take your whole life policy, your permanent life insurance policy, and how you can make sure that you have some living benefits. Because see, when you talk about this insurance, this is life insurance. Most people have death insurance. Most people have death insurance, meaning it only is good when you die. This is life insurance you can actually use while you're living. We're going to talk about all of those things come this Sunday in part two. Part two of 40-year mortgages are the best thing ever. And we're going to employ this whole idea of infinite banking and 40-year mortgages all together. My. What a thing. What a thing. What a thing. So listen, we've got some moderators on the stage. So Credit Goddess, are you still with us this morning? You still there? Okay. So Troy, why don't you go ahead and do a quick outro, and then I can do. We're going to do a quick reset, and then we're going to say goodbye. We've been here an hour and a half. All right. And we're going to say goodbye for the rest of the morning, and then we're going to come back on Sunday and do part two. So Troy, go ahead and give us a quick outro. Thank you very much for your valuable input this morning.
Again, John, thank you for holding this space, and thank you for educating us. I've been even enlightened even more. So I really appreciate it. And I think most of my enlightenment came by listening, and then also going to the YouTube. So I was watching on my desktop on YouTube, and so actually seeing it. So I really, really appreciate what you're doing. Make sure y'all follow Don, follow his house, and connect with him. But for those that don't know, my name is Troy. I own a company called Troy Hope Consulting. I'm the CEO. The CEO stands for Chief Encouragement Officer. My title is my personality, and I'm a certified financial educator. I'm on a mission to eliminate financial illiteracy. And one of the things that I use for that is life insurance products. And what I try to tell people is that life insurance, one of the primary benefits of it is to prepare for if you pass, to cover your debt and expenses and everything. But also I try to tell people with life insurance to educate people, hey, let's maximize your dollar and make it not just death insurance, as Don said, life insurance, by putting money away in strategies and using it a way that helps benefit you and build wealth. So my name is Troy, and I'm done speaking. Thank you again, Don.
You're so welcome. You're so welcome. Again, folks, listen, we're going to get out of here, but I need to share with you. So if you want to know the month, day, and year you could be debt free, whatever mortgage you already have, all right? And the debt that you already have, how would you like to know the month, day, and year you could be debt free and how much interest you could save? Click on the link above, the ice10k.com, ice10k.com, and then click the button that says get a savings and earnings report. You can know today, tomorrow, the next day. Get it filled out, and you can know when you could be debt free and how much interest you could save. And then the smaller small percentage of the interest saved pays for your lifetime P.I.L.L method program. Oh my goodness. Money you are going to give to the bank, small amount of it, pays for your lifetime program. And then you have this for the rest of your life. So let's go ahead and put that on the screen. We're going to, and so we can hurry up and get out of here today. So folks, get your savings and earnings report. Not only can you know the month, day, and year you can be debt free and how much interest you could save, we're going to do an earnings report for you as well, and do a projection on how much money you could earn with the interest you're no longer paying the bank. this is crucial. This is key. It's a savings and earnings report. So we're not just talking about debt elimination. We're talking about wealth creation at the same time. So go ahead and get that filled out today. Also on
Dan, I'm Don.
Yes, sir.
Keep calling you Dan. Don, what's the site that you use for that mortgage calculator?
Oh, the site that I use for the mortgage calculator is called brettwhistle.net. BRETWHIS as in Sam, S as in Sam, EL.net. Brettwhistle.net. That's our teaching tool. That's not our program. That's just a teaching tool. Okay. And on Sunday, we're going to get into this deeper and show you our program, our AI system that does all of the math for you. We're going to show you that as well. Okay. So folks, go ahead and get that information today and get my book. The same button, ice10k.com, has another button and how you can get my book. My book, The P.I.L.L Method, A Better Way to Eliminate Debt, is the only one out of 33 million titles that begins to help people to understand what we're talking about here today. All right. It is the only book that we know of in the Library of Congress that talks about this. So why isn't Dave Ramsey talking about it? Why isn't Susie Orman talking about it? Why aren't they showing us how a 40-year or 50-year loan could actually work in our favor? Why aren't they showing us this? Why aren't the other financial gurus showing us this? Because I own the copyright. I own the copyright. Okay. God has blessed me with this. And that's why they have to get permission to use this information. And folks, right now, I want to make sure that I give away as much of this information as I possibly can for free so that you can understand what's really going on for you and your family. And then if you so choose, you can become part of the P.I.L.L Method family as well. We'd love to have you as clients. So get the book today. Get the book today and start understanding this not only for yourself, but for your children and your grandchildren. Okay? Now, also on the same card, ice10k.com. If you've been inspired, and you want to know more about this and you want to share this information with others, there's another button on there that says how to become an affiliate. It takes about 15 seconds to fill out. Become an affiliate. And then we'll talk to you about how you can become an arm, an extension of the P.I.L.L Method, sharing this with others. All right. Wow. And you can actually get paid for sending people to our YouTube channel, having them watch a few videos, follow up with them. And if they're interested, then on that same card, you can refer a friend to the P.I.L.L Method. And if they become a client, we will pay you. Now, I'm going to go over this right quick. How we do our referral fees. Are you ready? Are you ready to write it down? All right, so here's what we're doing. It's exciting. It's very, very exciting. First of all, you want to send us a client that has at least $100,000 in debt and a mortgage, okay? Now, they could have $100,000 in debt, like student loans, and no mortgage. They could have only a mortgage, but it's at least $100,000 in debt. Or they can have a combined $100,000 in debt from other bills, like student loans and a mortgage added together. That adds up over $100,000. So we want to make sure that they have $100,000 in debt and a mortgage. All right. So now here's the next thing. Send them to our YouTube channel. We got over 200 shows out there that they can watch. Follow up with them in 48 hours. And if they're still interested, you fill out the card that says refer a friend from the ice10k.com video card. All right, send that in. And then here's how how we break down. All right. The first one you send us in a month that becomes a client, in that same month, we'll pay you $300. Send us a second one in the same month and it becomes a client, then we'll pay you $400 for that new client. The third one you send us in the same month. Okay, so we got 300, got 400. Ooh, the third one is worth $500. We'll pay you $500 for that one. And the fourth one you send us in the same month that becomes a client, we'll pay you $600 for that one. And the fifth one you send us in that same month, we'll send you $1,200 for that one. $1,200 for the fifth one in the same month, for a total of $3,000. And all you're doing is sending them to the YouTube channel, following up with them, and then sending them to us. And when they become a client, that's your client. You don't do anything else. You don't do any selling. You don't answer any questions. You just fill out the form, send it to us with your name and number. That locks it in. That becomes your referral fee. It is that simple. Oh my goodness. So take advantage of this, folks. Take advantage of it right now today. Now, I love this video card. I love this video card. And when you click on that, you will see at the top, Eric Thomas. Eric Thomas, E.T., the hip hop preacher, the #1 motivational speaker in the entire world, has used the P.I.L.L method to pay off his mortgage. And so we're going to end with that today. I want to thank Troy. I want to thank Jonathan for being here. I want to thank Sonia for being here, and Brenda. Listen, I don't know why I keep having a hard time with your name. I'm sorry? Agnete. Okay. Thank you so much for being here and being on the stage with me today. So, folks, our last thing we're going to do is hear from Dr. Eric Thomas. All right. And how he has benefited, and he and his wife has benefited from the program. But be back here on Sunday when we're going to go into this thing a lot deeper about 40-year mortgages and add to it the benefits of permanent life insurance. Thank you, everybody, for being here today. We will see you again on Sundays. Let's hear from Dr. Eric Thomas, and goodbye, everybody, for today.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.